All right, Zach, welcome to your first live on the Retirement Nerds.
And it feels surprisingly different than just chatting with you.
It's
I
a
don't
lot
know.
more nerve-wracking.
It is.
Yeah,
It
but
is.
I think it's also a super fun experience to engage with people. So for anyone who's watching live, you are more than welcome to throw in your questions as we go through this topic. And the topic is my question to Zach: if you were my financial advisor and I got a large influx of cash, what would be my next steps to do with that money? And I think we will talk about a lot of mistakes that people might make, but also some more wise decisions that they can make from this. And I have three scenarios. So if you're okay with it, I have three scenarios that we can kind of work through in order. And then when we are finished with the scenario, we'll kind of look over to the questions and comments, see if there are any questions around it. So the first scenario that I want to talk about is I got a raise. And I'm going to say that I got a $30,000 raise to my salary just through my work. So that's what I'm coming to you as, Zach, financial advisor. What should I do with this money?
How often do you get paid?
I get paid twice a month.
Okay, so this $30,000 will be spread out over 26 payments,
Mm-hmm.
roughly. I mean, oftentimes they do 26. It's every other week. Is it literally twice a month, or is it every other week?
Let's do every other week if that's easier.
Because that was easier.
Yeah.
Thanks for making my math right after the fact.
Yeah.
Okay, so $30,000 raise. Now, for somebody who's making a lot of money, like $300,000, $400,000, $500,000, that's a normal monthly fluctuation. For someone who's not making a lot of money, like that's a big deal. So, how much are we making so far?
We're going to say that I was making $100,000 and now my salary got bumped up to $130,000.
Okay, all right. So there's $2,500 a month of additional income here. And I think your first step is to determine what your real raise was,
Okay.
because you didn't get a $2,500 raise. You got something less than that, because money will be pulled out of that as we go, right? How much are you contributing to the 401k?
My
Percentage-wise.
company has a 3% match up to my first 3%.
Okay, cool. And have you been contributing so far?
Yes.
Okay. Do you do a percentage, or do they allow you a dollar? How do you do it?
3%
Okay.
is kind of easiest for
Okay.
me.
So you're putting in about $3,000 a year right now, because
Mhm.
3% of 100, and got it. And they're giving you another 3, so you're getting 6 in. If you continue to do 3%, now we're looking at not that much more, on 30,000, you're another 1,000, just shy of $1,000 of additional contributions. So your bonus is now, or not your bonus, but your raise is now 29,000 a year, right?
Okay.
Because and we're going to get down to the bottom number of what your true increase in take home pay is, so that you can determine what you can actually do with it. But we're now down to about 29. At this level, and your family situation is what?
Well, let's say that I'm married and I have 2 kids.
Okay. So at this level, and I assume you're filing taxes jointly.
Yes.
So you have been in a really low tax bracket, and
Yeah.
you'll likely stay there, because I'm just going to assume that you're taking a standard deduction. And if you're not, you're taking a deduction that's just a little bit more, unless you're giving everything away to charities. But I don't know if you figured out how to live with a family of 4, giving a ton of money away to charities on that income, let me know. But let's say that you have about $25,000 to $30,000 worth of deductions, which is about where the standard deduction would be for a family like yours. And you'll have some improvements because of your kids and things like that. So your tax bracket, let's call it your marginal tax rate, is going to stay likely inside that 12% tax bracket, because the top of the 12% tax bracket for a married filing jointly couple is 97,000.
Yeah.
So first section of your income is 0 because of standard deductions and other reductions you may be able to take. The next section of your income is taxed at 10%. And then the next section is taxed at 12. And if you touch the 22 at all, it'll be very, very little.
Yeah.
So bottom line is good tax situation. So of your 29,000 left, you're going to pay about 12% of that away in federal taxes.
Okay.
So we're going to subtract another $3,500 from it. So now we're down to what, 26, 25.5. So, and then there's state tax here in Utah. right?
Mhm.
So here in Utah, it's about a 5% state tax. So we're talking about another roughly $1,500 on 30,000. So we'll take that down again. So now we're down to about what, like 23,000, 24,000. So that's great.
Yeah.
Um, you are really close to $2,000 a month
Yeah.
in additional income. So your $2,500 a month raise, or $1,250 a paycheck approximately, which is huge. That's cool. That's the 2,500 is down to about 2,000.
Mm.
Okay. So there are other things that come out before, but they shouldn't change based on your raise. Like your healthcare premiums aren't going to change because you make more money. Well, that's not fair. I actually worked for a company at one point where it does. And so there might be other things, but once you hit a certain income level, they made you pay more of your healthcare premium. Okay. So you have about $2,000 a month. What does a bank account look like for you guys? Do you guys have how much do you keep in cash? And obviously, we're not asking you
Yeah,
specifically. We're
this is
doing
all
hypotheticals.
hypothetical. This is not my real I have 3 kids, not
Yes,
2, so you already
that's
know.
the only difference. Everything else
Yeah,
is exactly like Eric's
yeah.
life.
No, so bank account wise, just to kind of set the scene for what's going on here. Let's say that I have a little bit of cash. I have been living quite close to paycheck, but not fully. There's a little bit in an emergency fund. We'll say I've got 2 months worth of savings into an emergency
Oh, that's
fund.
pretty good. Because
Okay.
2 months should wait a sec though, because at $100,000 of income, 8,000 approximately gross, probably take home pay is around 5 or better. So you're saying you have like $10,000 in the
Yeah,
bank?
in the bank. Yep, I
That's
do have.
actually that's actually pretty good compared to most people at that income level.
And then hypothetically, I've got a house in terms of debt. I've got a house with a mortgage, and then we have cars for my wife and I, and we both have payments. We'll just call it $500 a month on each.
Okay. Okay. So
And the reason that I bring this up, just for a premise, so I released a video called Retiree Regrets, where I asked retirees what their biggest regrets are now that they are retired. And one of the common ones was taking raises and living outside of the means. My level of living went up disproportionately with the raise. So that's kind of the impetus for this question of, okay, I've got a $30,000 raise, and already instead of $2,500 a month, it's dropped down to less than
right,
$2,000 a month. So my decision making, I think,
right,
is impacted if I know that, rather than thinking I've got $30,000 to play with.
right. I'm gonna grab a financial calculator app on my phone just to be able to run a few things together here. But let's say somebody is making $100,000 a year. So I'm gonna throw out another. Well, sorry, so many thoughts. It just went like 4 in a row, and I didn't get any of them out, Eric.
I'm ready for them.
Um, so okay, let's start that over. That's a really valid point. You need to offset that with the fact that many people end up on their deathbeds wondering why they did not spend more money, why they did not go on more vacations, why they
Mhm.
did not enjoy their lives enough, or and why they didn't retire earlier. I mean, there are a lot of regrets we hear on that side as well, right?
Right.
So let's throw that out there and make sure people are aware of it. But this concept that Morgan Housel talks about in his book Psychology of Money is the movement of like moving the goalpost. So you're playing a game, goalpost is here, and then partway through the game, the goalpost gets moved, another 30 yards out, and all of a sudden it seems so much harder to get there. Well, that is what happens. That's what lifestyle creep does to your retirement nest egg need. So there was a lot in there, right?
Yeah.
Um, what I mean by that is if this person who now has about $2,000 more a month net of 401k contributions, which by the way aren't enough, and then
Mhm.
net of the tax liability for federal and state here, if they took everything that's left and just spent it, they now have, let me do a quick calculation here. They need approximately 600, 700,000, maybe $1 million. Well, let's call it 600 to $800,000 more in retirement to fund that additional lifestyle that they just took on.
Can you explain your thought process on that math that you just did to
Yeah.
get to that number?
So everybody has a certain amount they're accustomed to spending, right? And hopefully, when we get to retirement, you have income that can replace your earned income and help you continue to live that lifestyle. When you get to retirement, most people report back to us that their expenses drop. Now, we're going to get blown up in comments, and
Mhm.
that's okay, whatever. But that's the bottom line. Is most people say their expenses drop. They complain about their expenses more, but their expenses oftentimes drop, which is so bizarre. Um, the reasons are you're maybe not spending as much money on like your work activities, clothes and travel, commuting. Like you slow down a little bit, and anyway, so there are just some changes that happen there. Um, that is separate from the concept of inflation. Now, from a set dollar amount, obviously inflation makes everything go up, and we all spend more. Okay, so coming back to this math here that we're talking about, your retirement nest egg needs to be big enough that you can take money out of it and then spend it without worrying about what it's doing to the principal that you had. And if you're taking too much of it too quickly, then your interest on your portfolio isn't going to make it back, and then the portfolio eventually runs out. And for some people, that's fine if it runs out the day after they die.
Mhm.
But for a lot of people, it's really stressful to worry about the possibility of it running out sooner. So, in order to ensure that it doesn't run out too soon, there are many different mechanisms and tools and ways you can diversify income. And we're not talking about that today. So, I'm just using very basic rules of thumb, which, 3.5%, 4%, 4.5%, 5. I actually think that whole 4% rule thing is not helpful because most people can withdraw more than 4% from their portfolios and still be quite safe and not run out of money. But that's still a pretty conservative way of looking at it. So if
Yeah.
you divided this additional lifestyle, this additional $20,000 by 4%, 4.5%, or by 3.5%, you're going to get somewhere between $600,000, $700,000 of basically what you did. You moved the goalpost $600,000 further away.
Mm.
You can't retire until you have that much more in today's dollars
To live the same lifestyle that
to
I
live
am currently.
the lifestyle you just crept into.
Gotcha.
Does that make sense?
Yeah.
Now you're currently living on $100,000. So if you can control that creep a little bit, then you may not need to move that goalpost out. So that's something to be really careful and aware of. I actually think it's important for us to, as we have these wins, like you got a raise. How exciting. I think it's important for you to not deprive yourselves so much that you never let yourself enjoy any piece of it. You save every dollar. I think that people experience that as regret later.
Yeah.
And not only that, I know a ton of couples that I've met with where one spouse in particular has had that mentality and trained them with so much discipline that when they get to retirement, they have an insane amount of money and they can't emotionally and frankly physically figure out how to spend it
Mm.
because they have built the habit of saving so it's so deep, it's so ingrained, they can't figure out how to enjoy it anymore.
Mm.
So there's this balance to find in all of
Yeah.
this, right? Now, the flip side of that is you took the entire $24,000 of net pay and you increased your lifestyle. You're not saving any more towards retirement, and you moved the goalpost $700,000 further away before you can retire. That's the other side of it.
Yeah.
So finding the balance, I think that's what we're talking about today, right?
Yeah. No, for sure.
Okay. So what does that help with the math as to what I was talking about?
Yeah, yeah. Where you got the $600,000 to $800,000 goalpost move is kind of the question that I had there.
Yeah.
Yeah.
So you have this $24,000, and I'm assuming people are kind of coming in as we go. So I don't know how
Yeah.
much of recapping we want to do, but I also don't want to bore the people who have been here the whole time.
Yeah.
We're new at this.
Yes.
I'm new at this.
I'm also new at this.
Okay, so we have somebody who has a raise, $30,000 raise. We've determined that probably around 6,000 or so is going to go to the current 401k contribution of 3% of pay, as well as federal taxes and state taxes. And that's probably about right. So they have $2,000 a month that they can choose what they want to do with. And this then becomes a question of, okay, what have you done to protect your financial well-being? There's this process in financial planning where like it's an emergency. Like when your kid's in the middle of the street and the car's coming fast, you just scream at him. You don't speak kindly. You don't talk slowly.
Yeah.
You scream at him. You rush out there. You get him out of the road. Like the question is, in what way are you standing in the middle of a busy street and the cars are coming fast and you just need to get yourself out of that danger for a little bit? And you already mentioned emergency funds. That's one of them. Another example, I call it plugging holes in the boat. Not having an emergency fund is a big deal. So you have $10,000 worth of emergency funds, which we determined is about 2 months worth for a family of 2 parents and 2 kids. Does your spouse work?
No, just me.
Okay. If your spouse does not work, the conventional rule, and by the way, emergency funds should be measured in the months of cash you have. In other words, your income goes away, your cash, when you're being very careful, so it doesn't mean like how much are you spending currently, multiply that by number of months. It's if you had to tighten the belt big time, which you would if you lost your job,
Yeah.
how many months would that go? And right now we're saying it's probably 2 to 3 months because you tighten a little and maybe stretch your 10,000 over 3 months. The problem is that if you are the only earner in the household, 2 to 3 months isn't usually enough because if you have 2 people earning, then the likelihood of both of you losing your job at the same time is actually pretty low. And if one person loses their job, the other one can carry for a little bit until this person gets their job. And oftentimes they actually don't have you both not working at the same time.
Yeah.
So if you have dual income, the conventional rule is 3 months worth. And if you have a single income, or if you're a single person only, then you should be shooting for 6. And then the emotional side comes into this as well, which is um, some people are just not comfortable with only 6. Some people want a year, 2 years. Like that's a comfort level, and it actually helps them invest more aggressively in the rest of their portfolio. That's fine. So you have to figure out what your level is. But
Mm.
right now, this family that we're talking to, you need to take, let's call it, I would take another $10,000 to $15,000 worth of this extra 24 that you're going to have, which means about $1,000 a month. So once again, you mentioned this is coming in slowly, right? Because it's a raise.
Right.
So this person's getting approximately $1,000 more every 2 weeks. Every paycheck, they should be putting $500 towards their emergency fund
Mm.
for a year. Let that happen for a year. Or if they're like, no, I'm really stressed about that emergency fund, I'm going to knock that out as fast as possible. They should be putting all of the excess towards the emergency fund. There's a reason why I wouldn't do that though, because there are several equally dangerous vehicles coming your way, and you're standing in the street.
Mhm.
So with this extra $2,000, we're gonna say, all right, let's get rid of that risk, let's get rid of that risk, and that all at the same time, get you out of the street and put you in a safer spot, so we can at least breathe and talk about your finances a little
Yeah.
bit better. So item 1, emergency fund. I would allocate somewhere between $500 to $800 a month towards the emergency fund until it reaches 6 months worth of tightening of the belt spending level.
Yeah. Okay.
Anything on that you have questions on it that we add?
Emergency fund? No, I don't think so. And I like the idea of considering that with single versus joint, as well as income and who's bringing in income, one versus multiple. In terms of, I don't know that it's necessarily to advise on where to put an emergency fund, but does it make sense to have it in just a regular savings account, a high interest savings account, a money market account? Like
Yeah,
what are options?
totally, wherever it won't lose money if markets drop, because DeepSeek comes out and NVIDIA is supposedly not as needed as
Yeah.
everyone thought they were as needed in AI, and
Yeah.
all of a sudden your emergency funds are gone, that's a problem. So you need to have it in some sort of safe interest-bearing account, but be careful that you're not locking it up for a period of time in like a
Like a CD or
like, well,
something.
a lot of CDs you can take it out, you just don't get the interest or you have a little penalty, but that's a good example. Like you want it in something or the highest paying money market that you can find,
Okay.
and that the institution is safe, so it
Yeah.
doesn't go away, right?
Okay.
But that's where I would be putting this emergency fund. So of the 20,000, we think in year 1, you're going to need to dedicate about 12,000 of that. And sorry, of the 20 to 24,000 of the net raise,
Yeah.
right? The raise was 30, 20 to 24, 12 of that should go to building the emergency fund. So now we have approximately $12,000 left that we can start talking about. And the next step is, well, first of all, let me ask, do you have credit card debt?
In this case, we'll say no.
Okay, wonderful. Um, Perfect. We need to work on the big what ifs.
Okay.
So, what if you die and your family needs money? Like, what if you become disabled? What if you guys are unable to take care of your children either through death or some other cause? Like, who is actually going to take care of them? You know,
Yeah.
these are some of the biggest. Um, and then what if somebody gets hurt on your property and they sue you? You know what I mean? Something
Mhm.
like big liability. So those are your big four. What if you die? What if you become disabled? Those impact your earning power. And what if that happens, and what will happen to your kids, and then liabilities. So those four can be tackled pretty quickly with insurance. And my preference would be get the cheapest insurance you can. Do things like term life insurance with a quality institution, but that has the best and lowest rates possible, and get enough life insurance. And that's another question. That's actually a bigger, how much is enough? We can talk
Yeah.
about that if you'd like, but the bottom line is, what if you die? You need to have life insurance. If you don't have enough money, that your family would be fine. Now, if you have enough money that your family is fine if you die, we should be talking about retirement, right?
Mhm.
But I mean, that's kind of what retirement is. When you get to the point where you have enough money, you don't need to work anymore. Life insurance. People forget about disability. I oftentimes mention, what if you don't die?
Yeah.
That's actually potentially a bigger issue, because
Well,
you
especially if you have life insurance, but you don't die,
exactly. You
right?
become disabled, but you don't pass away.
Yeah.
You're not able to do your profession for whatever reason, and your family doesn't get any money because you didn't pass away,
Yeah.
and now your family's trying to figure out how to make ends meet. Those are really tough scenarios. So you need disability insurance for that. And the two main types are any occupation and your own occupation. It's different.
Okay.
So any occupation disability means they're not paying you if you can do anything. So if you can be a Walmart greeter, no disability payments.
Okay.
So if it's own occupation, then it's like a surgeon who maybe had his hands like cut off in a car accident or something like that. Like, that person can no longer do their own occupation. So that type of profession for sure should have an own occupation disability policy.
Okay.
So that's what if you don't die, what if you become disabled? Guardianship rules. Now, guardianship's tricky. It's normally a document that's built into the full estate plan. So if you feel comfortable enough to dive into your full estate, like foundational estate plan, which is a trust, will, power of attorney, and healthcare directives, the guardianship is usually built into the will, sometimes a separate document to make document 5. That's usually a package. I'm not as concerned about all of that as I am about the guardianship in particular, because
Mhm.
you really don't have today all the assets. I mean, yes, you own a home. It would be nice to have a trust so it doesn't go through probate, but that's not the end of the world, especially here in Utah. I mean, it's not terrible to have to go through probate, but it's not ideal. But it is terrible if your kids go to someone they shouldn't.
Yeah.
So that's where guardianship really matters. So it may make sense for you to take. So, by the way, on the life insurance, you might be spending another couple $100 a month for quite a bit of life insurance for you and your wife. And then the disability might be half that per month. And so we're not chipping away at very much of that raise to
Yeah.
to solve these two
Right.
issues, right? And then the guardianship docs, I mean, a full estate plan can cost anywhere from 1,000, 1,500. And I know Jim's been on, he's been really reasonable, but up to a couple thousand to 10,000, depending on how complex your situation is. But oftentimes you could find an attorney to do guardianship docs quick for less than $1,000, 100, 200, 300, somewhere
Yeah.
in, a lower. So that's not really common, and estate planners will probably be like, "Why not just do the whole thing?" And the reason I would say, "Why not do the whole thing?" is because we're talking to somebody who's in the middle of the street, and they
Mhm.
don't have time to just sit and breathe easy. They just need to get a few things in place and be ready to go. So, guardianship docs. Now, if they won't do it and you can't find anybody to do it at that level, at least make your wishes very known. Maybe write them down. Like, that might be helpful later in the probate process to be able to determine
Okay.
it's for the judge to determine who gets your kids. Um, Liability. So this is having good property and casualty insurance on your cars, on your home. Actually, just sent an email to my PNC agent today and said, like, I'm confused. We have this policy for this. We have this policy for this. Talk to me about what I have. Do you think it's enough? Like, you have to be a little proactive with that kind of thing. And then with property and casualty, oftentimes people should have an umbrella policy, which is a pretty cheap way to put like a cover over the whole thing and say, if my property and casualty isn't enough, if my car insurance isn't enough, if my house isn't enough, I've got $1 million of excess liability coverage for like a really, really bad scenario, and that won't cost people too much. So those are your big four, like solving for those big four what ifs. So your process was I needed to make sure that I got my emergency fund, and that's going to suck half of this race, which
Yeah.
is just a little bit of a bummer, because you're giving maybe 10% of it to 15% of it away to taxes, and then half of it away to your emergency fund. Now, the good news is you only have to do the emergency fund once, and then, taxes don't go away, but at least the next year you've got that extra money that you can now find
Yeah.
more fun things to do with it. Your total cost of solving for these what ifs probably going to be less than $1,000 a month for sure. It's going to be a couple to several $100s a month for all of
Because
those.
that's really what I had wiggle room for left is $1,000 a month after
Yeah.
all of this. Now I'm left
So,
with 1,000.
so unfortunately, it might take it all up. But then again, that emergency fund, once it's settled after 2025, which is where we currently are, in 2026, you get to think of more fun and better ways to spend and do things and save with that money you were putting in your emergency fund. So let's say it costs you another $300 to $400 a month, and that's probably fair. So we're sitting on about $500 to $600 left a month. And you mentioned there's no credit card debt. So those are my big three that you're in the street and you're in problem is so emergency fund, solve for those big four what ifs, and then high interest credit card debt. Once you get those three taken care of, now you're sitting on the side of the street and you're not in as much danger, and you can be thinking about things a little bit more carefully. And now it's time to get free money wherever you can. So you mentioned that your 401k plan offers a 3% match, and you're contributing to get the 3% match, right?
Yeah.
Okay. Do they offer any other plans at work?
Well, I think where you're going with this is like potentially like an HSA arrangement.
Or employee stock purchase plans,
Yeah.
or but yeah, in particular, it's
Yeah.
those three.
Hypothetically, we'll say I have an HSA,
Okay.
a high deductible health plan that has an HSA.
And you're on the high deductible health plan, you're
Correct.
saying, okay,
Yeah.
that was convenient.
Yeah.
And then your employer, do they match at all into the HSA, or is it just your own
Yeah, they'll
contributions?
do up to $1,500 a year.
Okay. That's their immediate. That HSA is tax-free on the way in. It grows tax-free, and then if you use it for healthcare, it's tax-free on the way out. If you don't use it for healthcare, it turns into an IRA if you want to use it that way.
With no
After age
RMDs.
65. Yeah, that's true. And it doesn't have RMDs with the
Required minimum distributions.
Yeah, which is when you have to take money out because you got old and they are tired of the tax break you've had on it.
Yeah.
That we're going to hit that for sure next. So it's over $100 a month, approximately. You need to be contributing that and getting that. And then at this point, I would actually contribute the rest of whatever you have. So you have did we say $600 left over? I would contribute all of that to the HSA.
Okay.
And then if you can, I would not use it all on your healthcare expenses every year.
Right.
So I would contribute all that to the HSA. It's the only triple tax-free option we have here. It's better than a Roth. So that's why I'm not like, oh, go back to the 401k and do Roth contributions there. Nope, HSA's first.
Yeah.
HSA's better. So you make your HSA contributions, and then if you can, I have a Google Drive folder, and I take a picture of every receipt, and then I drop it in this medical receipts folder, and I name it with the dollar amount, then the name of the person in my family that it was for, and the date, in that order.
Yeah.
So at any point in time in the future, it doesn't have to be the same year. Any point in time in the future, I can look through the list and say, oh, there's $5,000 worth of reimbursable expenses in my Google Drive folder. I'm going to grab all of those and put them in one file. And then I'm going to move them to my reimbursed folder, and I'm going to send myself $5,000 from the HSA.
Yeah.
And that is all tax-free because it was to reimburse for medical expenses. And it went in tax-free, grew tax-free. And that's the other thing, you got to remember to invest the HSA, but that's a little bit down the road. You're just talking about what to do with a raise. I think we spent it.
Yeah.
Right?
Well, and with that, your reimbursement, that can be as far back as you want, as long as you were covered by a high deductible health plan and HSA eligible.
Yeah.
So to your point, you're 65 now, and you had $20,000 worth of medical expenses over the last 30 years, as long as you were covered by a high deductible health plan with an HSA, then you can reimburse yourself
Right.
for that
And my
tax
Google
free.
Drive folder is pretty big now,
Yeah.
unfortunately.
It's interesting because I send myself an email. I should probably do the Google Drive folder because I
It
send
seems
myself an
easier.
email and the subject line is the date, who it was.
Then you just have a folder in your email.
Uh-huh. Yeah.
Then you'll have to pull up all those emails
I
later.
will. I know. Yours is smarter. I'm just saying yours is smarter. But getting to
That's
the
what I
point
was
here,
hoping you would say.
so the first scenario is I get a raise, and what you have just delivered is kind of tough news for me who wants to spend more money and enjoy life on this raise, because I was thinking, sweet, I might go buy a new car, or maybe we sell our house and get a bigger mortgage payment, or do these other fun things. But kind of what you had talked about with the tax implications, with preparing for retirement, savings, taking care of these big what ifs, it's kind of gone away to that. It's not vacations, it's not extravagant options. And I think that's a mistake that a lot of people make is I got a $30,000 raise. I have about $2,500 a month more that I can spend in my life. And then they start spending that, not realizing that even if you take away the emergency fund and all of those what ifs, it's still not $2,500 that you have to spend. It's
Mm-mm.
not yours in that
No,
sense.
and it's interesting. The ideal scenario, we're hoping for you to get to the point where, so I know most people don't think that this stuff is fun that we're talking about,
Yeah.
but there are some financial moves that are more fun than other financial moves. Everything we've done so far is not very fun. Um,
But to your point, is kind of once you've checked off some of these, they're done.
yeah,
Like
some of them.
the future is bright.
Yeah, it's kind of, I mean, I think of it like you're getting into a particular activity. I mean, let's say you like golf. Let's say, so like this would kind of be like a golfer being like, I love golf. I want to go. And they show up and they don't have any clubs and they can't rent clubs for whatever reason. Like you have to have the equipment. Your financial equipment is your emergency fund, is the lack of credit card debt. Is the liability insurance in place, the life insurance, the disability insurance, the guardianship, like all of those pieces are the golf clubs in the bag, so you can finally actually get out and play around. And
Yeah.
that's what we're talking about here. And this family that we're talking about, they got halfway through filling up the clubs in the bag. But as a financial advisor, I'm not going to go much further. I might tell them, hey, just so you know, the long-term goal here, we really want to get that 3% contribution to retirement that you're doing to a higher number. I'm not going to go over all the details yet, especially because it's going to freak them out because the number needs to be like 5 to 6 times that.
Yeah.
You know what I
Yeah.
mean? Like 15 to 20%. Um, I'm hoping that once you get your emergency fund in place, that we could then take part of that $1,000 a month and make an incremental improvement on some of the more fun financial moves, the savings ones, the wealth building ones. Um, and then what happens after you get those in place is now you get to the pure fun things, which is more like vacations and there's this spectrum of financial, like building your financial equipment and protecting yourself financially, to building financial wealth in a fun way too, and then literally going out and just doing the fun things you want to do.
Yeah.
And you guys are still here. And I'm not saying you shouldn't have fun, but you should find ways to enjoy life as cost efficiently as possible right now, until you guys have a better emergency fund and have a few things in place.
Well, and we built this big hypothetical around all of this. And I think it's so important in a lot of the videos that we address this. If there is no one size fits all approach, and anybody saying you should do this every time or that every time is not
Right.
wise in ours, because you took a couple of things
Yeah.
with my family scenario or my work scenario or my emergency credit cards.
Yeah, if you
the
have an
whole thing
emergency fund
changes.
already that's like 12 months worth, this is
Yeah.
totally different. We checked that box and now we're moving on to others.
Yeah.
You mentioned credit card. If you have a lot of credit card debt, we don't get to do the HSA. I mean, we might. There's an argument to still do it depending on how much of an interest rate the credit card debt has, because that HSA is the match portion at least. Anyway,
Yeah.
it looks like somebody has the Google Drive system.
Yes. So we can show these comments. Sherry, do the same thing with
like
Google
that.
Drive. Someone uses an Excel spreadsheet that they back up.
So the
everybody's
only
smarter
thing
than
about,
my tactic.
no, I think just maybe for Tony a little bit here. The only thing about that Excel sheet is that I believe technically you have to be able to supply receipts for, and when you take money out of an HSA, you receive a tax form that is for the HSA distribution. And on your tax return, you are attesting to the fact that you reimbursed expenses, and that's why it's not taxable. Most of the time, it's just an attestation. But if they ever actually end up auditing you, and you have to supply receipts for it, it'd be really nice to actually have those receipts saved in a folder that you could just pull them
Yeah.
out and provide.
Well, and I have a little bit in my past life. I was working with custodians for HSAs, and some custodians for HSAs, they will auto substantiate claims that you have. So if you pay and they can see, oh, this is a medical bill, you're good. Others made you document with receipts everything. And in the case of if you are reimbursing yourself, then you're going to need you're going to need receipts if you get audited.
That's funny. He's like, I got it.
Yes.
He tried to keep it
Yeah.
simple.
Exactly.
No, that's good. I was looking out for you, Tony. I was just stressed myself.
Way to be, Tony. All right. Okay, so that covers the scenario. That the reason that I brought that up is in my mind, I got a $30,000 raise, and you did a great job of breaking that down into, okay, that isn't all at once. That's split up monthly, and then not all of that is yours. And then again, based on your situation, things can change. Scenario number 2 that I want to bring up is that I do get a large amount of cash up front. So it's not spread out over the year. And this could be a bonus. This could be an inheritance within a reasonable amount of, and I'm just going to throw this out there. It's $100,000 that I got as an inheritance dropped into my lap.
Cool.
So now I don't have to spread it out over 12 months.
Right.
So how does this change the conversation? And if I need to come up with a new hypothetical me in this,
Is it the same person? That was my question. Are we talking to the same person? Or I feel like we should mix it up a
let's
little bit.
do a different person.
Yeah.
Do you want a in more financial trouble person or more solidified financially person?
I don't know. You pick. Surprise me. But let's do a single person.
Let's do a single person. I am in my mid 50s. And so for the most part, emergency fund is okay. I've got a mortgage still, don't have car payments. I have some credit card debt. I don't have kids to worry about, grandkids. What else
Okay.
do you need to know?
I'm gonna rapid fire then on a
Okay.
couple things.
I just got to make them up.
No. Oh,
All
yeah,
right.
yeah. You do.
Okay.
Sorry. No, I want to know exactly how it is for you. Okay. So emergency fund, you say so we got a single person, you've got 6 to 10 months worth somewhere in there.
Yeah. And again, so let's say my income level is about the same. So now I'm at
Okay.
100.
So you're 130 now?
Yeah.
Okay.
$130,000.
This person got divorced.
Yes.
I see.
Yeah.
Okay. So the $130,000 of income and, okay. Just working through a couple things in my head here. So emergency fund is good. We have life insurance in place.
We have life insurance in place.
We may determine you don't need it anymore, but because you're kind of getting to that age where you might not.
Yeah.
But still working.
Yes.
What kind of income? 130. You said that. Disability insurance?
No.
Okay, so that one we're gonna.
And
There's
the
our
people
first.
that you talk to, are there very many who have disability insurance? Because
Not
before we
enough.
went down this conversation a few months ago, I hadn't thought of it.
No. I personally have 2 different policies of disability.
Yeah.
But yeah, I think.
Is that because of your past history, or is that?
A little bit, yeah. Anytime, having had cancer in the past, anytime I can get little chunks of like cheap insurance without having to go through health screening and stuff like that.
Yeah.
I do. so yeah. But I found I had one that I've had for many, many years, and I just found one that was way better. Higher limits in terms of what they pay out, lower premiums. Anyway, so yeah.
So first is to take care of disability.
I still think it's worth it. Well, okay. So we're at this age, we're at 55. The question is like, we haven't quite asked about assets yet, but if this person has enough in assets. So imagine a chart where you start off single person, no kids, no home, like your insurance needs are pretty low.
Yeah.
And then over the course of a decade, a lot of people spike their insurance needs through the roof by buying a home, getting married, having kids, like all these things, immediately shoot it through the roof with, I don't want to call them liabilities, but they're kind of like little walking liabilities, right? I mean, the kids will need financial support for a long time if you can't work. So the insurance need goes way through the roof. Then, and at the same time, your assets are really, really low because you're just getting started as a saver, right?
Yeah.
And then over time, as you get older, your kids start to get older, a little bit more self-sufficient, especially if they move out. I know a lot of people are like, they never ever get off the payroll. I hear that all the time, but they should get less expensive at some point in the future. And your mortgage may go away. So you can see all these like insurance needs bringing that line down as you get older, and then your assets are coming up as you get older. So there's this point at which they cross. And the moment at which they cross is the moment that your assets are enough. If a new life insurance assessment was done for you and we said you should have $2 million of life insurance, and if your net worth in terms of investable assets is also $2 million, it's like, why would I buy the insurance when I've got the accounts sitting
Yeah.
here ready to be used?
Kind of self-insuring in a
That's
way.
right. I don't like to say that because a lot of people are like, no, that's good or bad, and they think too much about the terms. But yeah, you just have enough money that you don't need it.
Yeah.
That's what they call self-insured. So okay, so we don't know that about you yet because I haven't gotten there, right? But you're at the age where I can't just assume that you need it. You might not need it at 55 years old. You might have saved incredibly well for the last 2 decades, and maybe you don't need it. Or on the flip side, your goalpost might be so close because you live on $2,000 a month and you're incredibly good at being frugal, and so therefore your insurable need is so small because your cash flow need is so small,
Mhm.
and maybe your debt is non-existent, and you know what I mean?
Yeah.
So okay, so we're working through, but I do think that it should be at least discussed and reviewed, which is life insurance and disability. Property and casualty, you got to have it. You got to have something there to take care of yourself. And then, do you still have these? Are these kids is the same family? This person got divorced, or is it a whole new person? Do they have different family situation?
We're gonna say a whole new person.
Okay.
No kids.
No kids. Okay.
No kids.
So we don't need to worry about guardianship either.
Yeah.
Okay, so we've basically put out some fires, plugged holes in the boat, got out of the street, whatever you want to call it. The dangerous ones are somewhat set aside. And you're currently getting free money from work, contributing to your 401k.
Yep.
Do you have an HSA?
Don't have a high deductible health plan.
Okay, so for those listening, Eric's not on a high deductible health plan, which is a requirement to be able to contribute to an HSA. So even if his employer does a match, that's not something he's going to be eligible for, which means maybe it's worth discussing and looking at that, especially as an individual.
Yeah.
But we'll see. That's a later conversation.
Well, and there are other like FSAs, HRAs that don't have the same triple tax advantage as HSAs, but if you don't have a high deductible health plan, ask your employer if they do have these other kind of tax advantaged accounts as well.
Does your employer have an employee stock purchase plan?
Sure.
Okay. So you work for, typically that's a publicly traded company. And what's happening here is you can set aside money from your paycheck, every paycheck, like a 401k contribution. And most commonly, they set it aside for a 6-month period called the offering period. And then at the end of the offering period, they take all the money that you've set aside and they let you buy the stock at a 15% discount. I'm giving the standard rules. Companies vary these by how much of a discount, the offering period, the frequency. So don't take any of that as gospel if you're out there listening. But 6-month offering period, and then the really cool ones have a look back. So let's say the stock was at $10 and it went up to $20. They'll let you buy it at 15% off $10, even though it's now worth 20. So, and if it goes down, if it was at 20 and went down to 10, they let you buy it off of the 10. So it's not just the first price, it's the lower of the beginning or the end price. So that's kind of cool. So that's free money. That discount is free money, right? Especially with the look back, you could end up pocketing a bunch of free money. And most of the time you can even just sell the stock immediately right after buying it. Now, if you do, you'll pay more of an income tax rate on it. If you want to hold the stock for, in this case, it would be about 1.5 years after buying it, then you could get a qualifying disposition on it and you'd get to pay long-term capital gains instead, which is going to save you about 10% of tax rate. Bottom line is it's free money. Sometimes people get confused about having to pay a higher tax rate. They're like, well, then I don't want to do it. And I would say, okay, well, let's play this game. If I give you $1 and you have to give me a quarter back, how many times do you want to play?
All of the times.
All day long.
Yeah.
That's how this works. So don't get caught up about whether it's a quarter or 15 cents or 10 cents you're giving back. Take the dollar and take it as many times as you can. Okay. So let's contribute to your HSA. This is a big influx of cash. If you were to, is there any room within your regular income right now that if you were to start contributing to the employee stock purchase plan? I think I said HSA a second ago.
Yeah.
I meant employee stock purchase plan. If you were to start contributing to the ESPP, would that impact your lifestyle, like your spending habits and capability?
Well, that means it's coming out of my paycheck, right, and not my inheritance.
Right.
So let's say that hypothetically, I'm in a pretty good spot here where I could make that adjustment, especially knowing that I've got a buffer on top of my emergency
Yeah.
fund of this extra $100,000 burning a hole in my
Okay.
pocket to do something fun.
Which we're not getting there fast enough, are we? So, okay, tell me this though, is your bank account each month, does it go up a little bit?
A little bit,
Okay,
yes.
perfect. So that tells me that you are spending less than you're making take
Yes.
home pay.
Mhm.
And okay, so we don't if it wasn't, if it was staying the same or just vacillating back and forth, then I would say let's still do the employee stock purchase plan, and then let's have you move a little bit of this inheritance in to help with your lifestyle. It's just a trade. It's a musical chairs of money in order to get the free money, right?
Yeah.
But since your cash flow can handle it and your bank account keeps rising, rather than having your bank account rise, let's have the employee stock purchase plan take advantage of that excess money. And we still haven't gotten to your inheritance, but I didn't know if you would need that
Mhm.
to help with your lifestyle
Yeah.
so that you could do the employee stock purchase plan. Okay, so once we've taken care of like the emergency fund and the big what ifs and high interest credit card debt, then now we're moving on to the getting the free money, which you're getting the 401k match, you're getting you can't do the HSA, and you are getting the employee stock purchase plan. Now the maximum on that's going to be pretty big. I don't know your exact numbers. I'd actually want to run some math here, but I probably wouldn't like go gung ho and max it out. I would just get you started in it right now and just try to contribute $5,000 to $10,000 a year of your income from it.
Okay.
And that would be a good starting point. And then part of the reason for this as well is we're going to create tax savings. Sorry, we're going to create retirement savings in different tax statuses.
Okay.
So you're going to have your 401k, and we'll talk late. And in the planning conversation, I would get to Roth versus traditional later. But then you'll also have, so you could have Roth, traditional, and then this employee stock purchase plan is after tax money. It's neither Roth or traditional.
Mm.
And so it has some different rules and some benefits of having it in each piece allows you to control your tax bracket in retirement a little bit better.
Okay.
So, okay. So we now move on to the point where we're even further away from that road that we talked about earlier, that really busy street with a lot of cars and you're about to get hit. You've actually taken a step back and you're like sitting on a bench in a park. You even can breathe and relax
Yeah.
a little bit, right? But what we're missing right now is we don't know if you're saving enough for retirement, and you're not that far away from it.
Yeah.
So the next project, next like assessment, the next whole like thing we got to do is figure out how much have you saved? How much should you have saved by the time you want to retire? And are you on track to get there? And do we just need to take this whole inheritance and drop it into the retirement projections? Or are we going to get there on your own contributions and things like that? So how much have you saved and what have you saved in?
Well, let's say that I've been relatively responsible and I have been contributing to my retirement plans, and I've got a sizable chunk, and I don't know what that number really is in this world, but let's say that I've got $500,000, $600,000 that I've got in retirement
Okay.
accounts. I'm hypothetically 10 years away from retirement if we assume 65 is when I want to retire.
Okay.
And so in that 10 years, I'm living off of $130,000 as my income with the mortgage, no credit card debt, anything else.
And really your take home on that 130 is probably, as a single filer, you're under 100, with the savings you're doing. And
Yeah.
so your lifestyle is probably built on a net of $80,000 to $90,000 of income right now. Do you think that's fair?
Yeah.
Okay.
Yeah.
I feel like I could tell you anything right now and you'd be like, that's
Hypothetical
right.
Eric thinks that's fair.
That's right.
Yeah. Hypothetical Eric is totally
so-
in agreement.
Okay. So $80,000 to $90,000. Okay. And have you been married before?
Yes.
How long?
For 10 years.
And how long ago?
It was about 5 years ago. So I got divorced at 50, having
Okay.
been
You were
married
married
for
from
10.
40 to 50,
Yeah.
roughly. Exactly how long was that marriage?
10 years and 1 month.
That's what I needed to know. Okay, was it more or less than 10? Is your ex-spouse
Why are you asking that? I know, but for other reasons, why would you ask that?
your Social Security benefit options vary based on whether or not you were married for 10 years or more versus under 10 years. And I'm thinking about replacing this income. So your lifestyle, we think, and I hope people understand that normally we're using tools for all of this, right? And right now we're doing a lot of mental math, but we think your lifestyle is around $80,000 to $90,000 a year, and it could be a little less, but who knows? That's a safe bet. And we're trying to fill that up. We're trying to figure out how to replace it. And we're trying to create income for you. Well, not create, but we're trying to organize the income you've created for
Mhm.
yourself. Social Security is going to be a big part of that, especially with how long you've been working and paying into Social Security. They're going to take 35 years worth of data to determine what your average income is and how much you paid in and all of that. Now you don't have 35 years yet. I'm just making stuff up, but
Yeah.
you don't have 35 years yet, but so there'll be some zeros in there, but it'll improve as you work for the next decade. But if you have a spouse, that does change options a little bit, especially if that spouse made a lot more money than you. Now, I don't think you're going to need to worry about spousal options a whole lot, because at about $170,000 is the maximum income that people pay Social Security tax on. So if you max it out, you stop paying Social Security tax that year, and it'll start again in January. What that also tells us is there's not a lot of room between your current income and the maximum. And there's also this thing called bend points, where they actually don't give people that much additional Social Security benefit for the FICA taxes, the income taxes they pay between $130,000 to $170,000. They give you a lot of benefit for the taxes you pay on 0 to 20,000, and they give you a decent benefit on 15 to 20 up to about 60 to 70, and then it's hardly anything later. Anyway,
Mm.
so the point I'm trying to make is, even if your spouse was making $500,000 a year when you guys were together, their benefit is not going to be so much greater than yours that we're going to need to worry about that.
And the fact that it's half of theirs.
And exactly.
Did I just ruin your reveal? Oh, I'm so sorry.
No, I don't care. Yeah, so you get half of their benefit,
Yeah.
and that means that it's going to be really hard for their benefit to be more than 2x yours based on your incomes. Okay. However, is your ex alive?
In 10 years, I don't know that they will be.
Okay. So this is a really weird situation. I don't know what your relationship is with your ex, but you need to keep track of them enough to know if they are still alive.
Yeah.
If they pass away, then you are eligible for their entire benefit, not half. And even if their income is less than yours, you could be eligible for a survivor benefit at age 60, while letting your own benefit grow all the way till 70. So it's a ways out. We've got about 5 years before this even could be a possibility. And I'm not asking you to wish ill on anyone, but you just need to be aware of if that ex-spouse is alive.
Okay.
Okay. So bottom line is, at $130,000 of income, you would expect over $3,000 of Social Security a month, 3 to 3,500, depending on when you file. It could be less or more than that. Filing early reduces, filing up to 70 increases it. But let's just say it's approximately, let's see, about $40,000 a year. So we're almost half of it of
Mhm.
what you need just in Social Security.
Mm.
So now the other half, $40,000, it would need to come from some other source. Does your company offer a pension of any type?
No.
Okay. How about rental income? Do you have other
No.
rental properties or
No
anything?
rental.
Okay. Is there anything that pays you other than your own work each month?
Just my work. Yep.
Okay. So now we know we need to find another $40,000 of income, and that's going to need to be created by your own savings and your own portfolios. So how much have you saved, and what kind of, like, tell me about retirement accounts?
That was the $600,000 in. Most of it's in a 401k, some
Yeah,
of
you
it's
already
in
told
some
me that.
IRAs.
See, normally we would take notes.
Yeah.
Yeah. Okay.
A little bit in Roth, a little bit in traditional, a lot in a 401,
Okay.
a traditional 401k.
So I'm going to make this real easy for people. Divide it by 25 or 20. Divide by 20 to 25. I'd probably do by 25 or multiply by 4% or something like that. There's multiple ways of getting there. But $600,000, I wouldn't want you. I mean, there are ways, and this is why it's so hard online, because there are ways of producing more income than that, but you are going to trade off. Like insurance products will promise you more income, but you trade off flexibility. And I'm not saying that's right or wrong. I'm just saying it's a trade-off, and it needs to be a conscious trade-off.
Yeah.
But if you're just saying, I want to be super conservative, if you want to take just dividends and interest, you should be taking 3% of the portfolio. If you want to take a little bit of principal each year and you're okay with that, depending on your age, at 65, you could start looking at 4.5 to 5%, depending on how the portfolio is structured. Anyway, so if it was 5% on 600,000, it would be $30K, $30,000 a year. That's pre-tax, and we need 40 after tax. That's today's dollars. That would be as if you're retiring today. So the reality is we start to then throw this into multiple market scenarios. And so I'm not going to go through all the math just yet, or on this call. I don't think it'll be that helpful call on this meeting. What do you call this? A live?
YouTube Live.
YouTube Live.
Yeah, people watching live.
Not going to be that helpful to go through all that math right now. But the point is, what are we doing? We are setting up, is Eric taken care of in terms of all the emergencies and problems that could really ruin his financial picture? Yeah, you're doing good that way. You're doing really great. Is Eric getting free money? Yep, he was missing a little bit of free money with the employee stock purchase plan. So let's start doing that. So we start doing that. And you can see this is actually the same process as getting a raise. But now we're looking at this $100,000 piece of cash in the bank. And now we're looking at the retirement projections, and with $600,000 and you needing only 40K or so, in 10 years, you're going to be fine. I can already tell you, in the math in my head, it's going to be fine. And the savings, even if we just tweak the annual savings a little bit, then we're going to overshoot for that goal, and it's going to be fine in a decade, and everything's going to be great. So that whole process, what was I trying to figure out? How much of that 100 is already spoken for? Yeah. That's all I wanted to know. And I wanted to know if you weren't going to be fine, if we had to carve off 70 of it and drop it into an investment portfolio to say, this is part of Eric's retirement from here on out, because it's going to catch him up because he needed it. Then now we know there's only 30 left. So that was that whole process was just how much is already spoken for. Now, the one thing we didn't ask was, what kind of money was this that you inherited?
It was a parent passed away.
Yeah, but what?
We sold their house.
Okay, it was their house.
We sold their car.
Okay.
We just sold a few of their things, and net of that, they had some investment accounts. That's what maybe you're getting at. Is they had some retirement accounts, a little bit from 401k, house, cars.
Got it. Okay. So depending on the situation, most likely you got what's called a step up in basis. So even though they bought their house back in the 50s or something, and they lived as your parents, probably not the 50s. Let's say the 80s.
70s.
Okay.
Yeah.
So in the 70s or 80s, they buy this house and they paid $80,000 for it, and they just sold it for $600,000. So that $520,000 gain, had they sold it, they would have had to have accounted for that. There are exclusions, and they probably wouldn't have had much tax at all in that scenario. But let's say that instead of passing away with it in their name and then transferring it to you, let's say they put you on it with them, and then they passed away, that takes away the step up in basis. Eric has to pay capital gains tax on the 520. Now, because they passed away and they get to step up the basis. So basically, basis is the number for what you paid for it, and your ability to say, I paid 80 is now your ability to say I paid 600. They just step up the basis, and it's not really I paid, but it's the cost of it. So if you sell it for 610 later, you only have to pay capital gains tax on the 10. So I'm assuming that the home was sold fairly quickly after. It normally is fairly quickly after, not a ton of capital gain after they passed away. So most likely very little tax associated with that. Once again, we're just trying to figure out how much of this is really yours, right? Some of it might go to taxes.
Well, and you and I have talked about this, and Jim has talked about this as well, the step up in basis around if you are on the title of the home with your parents, or you have put your kids on your title of your home, in most cases, that's not the wisest thing to
No,
do, especially from a tax
no,
perspective.
not at
So
all.
you can fix that. In a lot of cases, it's recommended to fix that. But in this case, because I listen to the retirement nerds, I've got it so where they have set it up and I'm not on the title of
Of course.
that house.
Okay, so you mentioned investment portfolios, and those work the same if they are non-retirement accounts. Then let's say they had this investment portfolio where they owned 10 different stocks in there.
Mhm.
You go to the brokerage firm, and hopefully the person who was the executor of this estate went to the brokerage firm and said, Mom and Dad passed away this date. Please step up the basis to that date. And then they go in the system. And by the way, this is important. I always, if possible, want the brokerage firm to perform the step up in basis before they start distributing all the assets to all the kids. There's several reasons. One, if you distribute the assets from one place to like an entirely different company and you transfer the shares, typically you just divide up 10 shares by 2 kids, 5 goes here, 5 goes here. Sometimes those other firms are like, we don't know anything about these shares. We don't want to be liable or put our own basis in here and like account for that for you. We don't know where they came from or what they were. And or they'll come over with the old basis and they're not as comfortable doing a step up, or they come over, the new owner doesn't know to tell the custodian to do a step up in basis. They sell them. They don't know that anything went wrong. They get a tax form in 6, 7 to 10 months when they file their taxes. They show a $20,000 gain or a $100,000 gain, and they still don't know anything went wrong. And they file it and they pay taxes on it.
Mm.
And it is just mind blowing that like no one, I mean, I get why, because it's not a normal thing, but
Yeah.
it's sad, not mind blowing. It's sad that no one along the way caught it. Also, it's a lot cleaner if you do it before the assets split up, because it's like you can already see the owner's passed away. You have to give a death certificate anyway. Typically, when you do a step up or an account change like this, you might as well knock it all out at once. And then
Can you clarify on that? So what you're saying is that if my parent passed away and they had funds in a Fidelity, a Schwab, one of these custodians, and I let them know that my parent has passed away, that's something that I can tell them, hey, do this step up in basis right now.
yeah, and usually there's
Okay.
a form.
Okay.
And you put in the date of death and they'll go through. I mean, they're required to have a ton of it. This is new law, new as of years ago, but new to ish. But they're required to track basis now.
Yeah.
So they've got the data. So yes, and they will likely require a death certificate and an authorized signature of whoever should have the authorization after they pass away to handle the account, and the date of death, and then they will take care of a lot of that.
Okay.
And it's worth it. Now, one thing that happens in these scenarios is the sibling is like, my brother is taking his sweet time getting this money to me.
Yeah.
And they think something's happening that's not happening. And sometimes something is happening that is happening. So I'm not trying to like, you know what I mean? Like
Yeah.
sometimes brothers and sisters aren't working well together. Sometimes this stuff just takes time to button it up really, really well and do all those calculations so you can then distribute the assets and save everybody in taxes. So bottom line, back to your scenario, house gets a step up. Brokerage portfolios where you own investments not inside IRAs and 401ks get a step up. And then you mentioned there were maybe some small retirement accounts.
Mhm.
What happened to those?
With my parents?
Yeah.
I don't know. What
Did
should
they,
happen
what,
with those?
I'm going to give you 2 options and then you decide
I
what
wasn't the
happened.
executor, so
Okay.
I just,
Did they cash them out and put them in your bank, or did they open up an inherited IRA in your name and transfer the assets over to that?
they cashed it out and then they
Okay.
sent a distribution.
Okay. So that will show up to you the next year in the early part, in probably February or March. You're going to get a 1099-R, which is going to show the income you'll need to report, because that, if it was a traditional retirement account, that is taxable income to you that you will have to report on your tax return.
Does this change if it was all in a trust? So
No.
if it was in a trust and it was all sold, then the trust is paying taxes and then distributing?
Kind of. Let's take
Yeah.
a step back. When you say it's in a trust, you can't technically take an IRA
gotcha.
and put it in a trust while
Gotcha,
somebody's alive.
Gotcha.
You can only do that upon passing.
Okay.
So, I mean, you can say that you did it all you want, but the IRS doesn't care. They're like, that is your social security number and that is your account.
Mhm.
And that's your minimum distribution required and all those things, right?
Yeah.
But you can put a trust on as a beneficiary of an IRA. And if you do that, then the trust inherits the IRA. Every IRA has minimum distribution requirements. So you have to take money out. Well, sorry, I shouldn't be so extreme. A spouse doesn't, but most all scenarios, an IRA that is inherited will cause you to take some money out over the course of your lifetime. And the calculation of that varies based on the type of beneficiary that it is and a whole bunch of other rules that we have this crazy flow chart that we keep in our
Okay.
office for that.
Okay.
A trust may force all that money out over 5 years. It doesn't have to. Most cases, if the trust is written well, it lets them go to 10 years. And in some cases, certain situations allow to stretch over someone's entire lifetime.
Mm.
You want the longest stretch possible because that allows you can always take the whole thing at any time. It doesn't mean you can't take the money. It just means you don't have to take the money.
Yeah.
And that kind of flexibility in finances is helpful.
Yeah.
But in your case, your executor didn't give you very many options.
Mhm.
So he just took it all out, and you're going to get the tax bill and tax form associated with that. So how much of this 100,000 was IRA money?
$12,000.
Okay.
I just want to make math not even
That was
super easy.
great.
$12,623.
No. Okay. So the 100,000, about $12 to $13,000 was traditional IRA money.
Yeah.
So that will show up as taxable income to you. In your situation, let's see, an individual, a single filer with this much income, that's 22% tax bracket.
Okay.
So
Magic Llama, this is a hypothetical. I am not actually 50 years old.
Oh.
So we just had
Eric is 50. That's funny. Okay. So you have, where were we? Tax bracket, 22% tax bracket. So of your 12,000, expect to pay $2,500 away
Okay.
in taxes or a little bit more federally and then state. So just that's not that big of a deal because you've got 100. I'm just
Yeah.
trying to prep you for that's another thing when you get to tax time, you'd be like, what?
But now it's down to 97,500
Yeah.
for that.
Yeah. And we decided that you were able to contribute to your employee stock purchase plan without
Mhm.
using
Blowing off
that money.
Mhm.
That employee stock purchase plan contribution, I would use that as a retirement account. Just so you know, I would put that in. And if you don't want to have that kind of concentration in your own employer stock, I would either immediately sell it or I would wait for the disqualifying disposition to end, which in a 6-month offering period is 18 more months. It's 2 years from the beginning or 1 year from the end, whichever is longer. So I would wait for that to end and sell it at a better tax rate. Then I would diversify and create a non-retirement portfolio, which can be so helpful in so many things. Like if you're giving to charities, if you want to do, you can give the stocks directly. If you're wanting to trade to reduce your tax bill a little bit for losses, you can do that. So there's just a bunch of little things you can do in that. And that's a good tool to have in your like retirement picture as you cross over. Obviously, I'd rather have everything in Roth because that's better. But to get it there, you have limits and things like that.
Yeah.
So, okay. So we're going back to the contributions. I think you should try contributing a little bit more to your 401k as well. And potentially based on your tax bracket at 22, I am thinking, I could be wrong, but I'm thinking you're going to be in the 22 or 25% tax brackets in the future. Because as we look at a single filer, that's $48,000 of net income.
Mm.
So it just feels like you'll probably be above that with a standard deduction of, let's call it $15,000, $16,000, $17,000. I just have this feeling you're going to have more than $60,000 of taxable income based on how much your income will be. And now the good news about Social Security is that when you don't have a bunch of other income, hardly any of it is taxed. So we're covering like a bunch of different topics you've done videos on with like that we've done videos together, right? But I'm kind of bringing all that together. So I'm thinking about what's Eric's tax bracket today versus his tax bracket in retirement. And if his tax bracket today is higher, I don't want you doing Roth contributions, paying taxes on that when at let's call it 24% taxes or 25 or 20 or more when you could get it out later at 10. Now, based on your current situation, we're unfortunately in a little bit of a gamble with the government and what they're going to do because before this current administration took place, I would have assumed that the Trump era tax cuts would have sunsetted, meaning at the end of this year, the 22 was going to become the 25% tax bracket, and 12 would go to 15. I was anticipating that. And obviously, with this new administration and the House and Senate going the way it did, it makes me less confident in that and more open to the idea of like, yeah, they could actually extend these tax brackets for a while. But 10, 12, and 22 are actually really low for the bottom three brackets.
Yeah.
They're pretty solid. So in other words, 22 is about as good as you're going to get. And I think there may be a chance, but without running projections, I'd want to see how much traditional money you have. There might be a shot at doing conversions at the right time to get you into, so you didn't have Roth, or you didn't have as much traditional money in retirement, and then you were in just the 10 and 12% tax brackets. If that was the case, I would for sure do traditional contributions right now and avoid the 22 because we think we're going to be at 10 and 12 later.
Yeah. Okay.
Okay. So what I'm saying is you've got this $100,000, which went down to 97. You're able to do the employee stock purchase plan without any usage of your inheritance. So we still have this kind of war chest over here that we're trying to decide how we want to allocate it. If we've used up your cash flow to the point where you're not able to make contributions to your retirement accounts, then I would maybe dedicate 10,000 of that towards your bank account and say, I'm going to try to put $10,000 to $20,000 more towards retirement. Could be Roth, could be traditional. And there are reasons in your situation to go both. When you're in the 22% tax bracket, it's not as cut and dry. When you're in the 10 and 12, it's almost always Roth. And when you're in the higher than 22, 24 and up, it's like, well, 22 and 24 is like, could be Roth or traditional, depending on future and current tax brackets. Anything above 24 is usually traditional.
Okay.
But those are rules of thumb, and there are absolutely scenarios that break that.
Yeah.
But anyway, so if we use 10 to 20 of that to help with lifestyle, especially if you're trying to build Roth funds, then, because for example, we can take that $10,000 or $20,000 and just put it in a brokerage portfolio, or you can get 10 or 20 less from your work, put it in a Roth, and spend this 10 or 20. It's all the same.
Yeah.
In one scenario, you have $10,000 or $20,000 in, let's just say 20 to make it easy. You have $20,000 in a brokerage portfolio on which you have to report interest, dividends, and capital gains every year. Or over here, you have $20,000 in a Roth and you don't have to report any of it, and you get to take it out tax-free. So even if we decide that, like, I don't really care to contribute that much over here, I would say, well, let's do some musical chairs at least and put money in your Roth and then spend some of this money. Okay. Then once we get beyond that, now I'm really starting to take a step back and say, what are the priorities here? Like, how important is it to you to build a really big nest egg versus maximizing life?
I would say in this hypothetical scenario of 55-year-old Eric who's divorced
Single.
with no kids, I would say that I would want to prioritize getting to spend more of my time how I want, maybe traveling a little bit more, with the idea that I might marry again in the future.
Okay. I like the hopeful romantic in you.
If
you could describe that though, does that mean like spending your time the way you want? That could mean one of two things. That could mean that you have enough money to be able to go and do things, or it could mean I want to retire earlier so I don't have to go to work as much, and I'm spending the money on not having to work.
I would say spending the money on not having to work.
Okay. Which, by the way, I actually think that like you're accidentally letting like your true self come through here because so then what that tells me is if that's a priority,
hopefully not the divorce part.
Well, no. Caitlin and Eric are fine, everyone.
We're doing great.
So if that's a priority, then I would start to repurpose, because we're talking about 70 to 80 left over here, right?
Yeah.
I'd start to repurpose this into retirement savings. And by repurpose, I mean model. I would use modeling tools to then say, what happens to Eric's situation if he puts $70,000 to $80,000 towards his retirement picture? How much more does that bring in his retirement expected date? And if he could retire at 60, 61, 62, then that sounds like that's what he wants.
Yeah.
He wants to retire earlier to be able to spend his time how he wants. Some people are different that way, though. They're like, No, no, no. It's not that I want to retire earlier. I just want more money to be able to book travel when I want to go and see the world and do the things, and or spend money on my kids and pay for them to get to go and to Disneyland more frequently and things like that.
Yeah.
So you really have to identify who you're talking to. But based on what you said, I would first model in, and then I would show you and say, hey, if we take this money here and we model it in, it shortens your work career by 2 years. How does that feel? Is that what you expected? Is it not? How does that look to
Yeah.
you? And then if you said, oh, gosh, I was really hoping, sometimes that will actually like uncover some of the feelings. And if at that moment you were like, oh, I was really hoping there'd be some left over to be able, I really have always wanted to go over to Europe or something like that.
Mhm.
Well, that's really telling, because that tells us now, like, oh, that's really good. That surfaced. Okay. Well, in that case, watch what happens if I take $5,000 and move it out. It changed it by 3 months. Are
Yeah.
you willing to, like, that's no big deal.
Yeah.
Like, just work a little bit longer. And now you get to do that now.
So we've talked about how if you let lifestyle creep come into play, you're moving the goalposts further away. In this case, you're moving the goalposts closer. So you're
Yeah.
kind of playing this balance between, am I going to do what's best for current Eric, or am I going to do what's best for future Eric?
Yeah.
And making these decisions
And
around those
studies
things.
have shown that to maximize happiness, your goal is actually to level out the finances over your life if possible.
Mm.
So rather than save everything for later or, YOLO today, I don't know. The, that's what a home loan is. You are borrowing from your future self to have the money today to be able to own the home, right?
Yeah.
And you're leveling out assets you'll have in the future to today. And anyway, so it's a concept. I can't remember who wrote about it now. I wish I did, but be able to attribute it to him. But that, in other words, it's a balance. But let me take a step back, because technically we're not moving the goalpost.
Okay.
We're just getting there faster. Let me
Okay.
explain what I mean by that. You're still spending the same amount of money. If you cut your spending by down from 80 to 60, that pulls the goalpost in, because
Okay.
now your nest egg doesn't have to be as big. So
Mhm.
that's what I mean by you're changing the rules of the game a bit.
Okay.
But if we're still spending the same amount, we're not moving the goalpost, but we got some help to get there quicker
Gotcha.
because we got some cash.
Okay. Is there anything that you want to go into in this $100,000 inheritance? Because again, the fear that I have is that I went through an inheritance. It wasn't the $100,000, but it was an amount. And I had to go through this thought process in my brain, right? Of like, okay, what do I want to do with this chunk of money? Now, I wasn't 55. I'm not 55 for those who are watching. Um, but it wasn't just this easy decision of I know exactly what I'm going to do. Also, it was figuring out how much of that 100,000 is really usable after taxes, after taking care of these goals. So I appreciate you kind of walking through. This
Yeah.
is kind of like a deep dive for those watching that maybe they are or not interested. Maybe they're just saying like,
Right.
Zach, just tell me exactly how many dollars I should do.
Right.
Can I just buy that new whatever?
And the reality
And
is, you hope that your financial advisor is doing this kind of like order of operations.
yeah,
Unfortunately, I fear that that's not what's happening. That in many cases it's 100,000. Here's this product. Put it all
mhm.
here.
And this came up in an email to me 2 days ago.
Oh, really?
Somebody called and they said, "Hey, I just met with a financial advisor and they told me to put everything in an annuity. So I have all of my money and they wanted me to just put it in an annuity because it's tax-free money for the rest of my life." Now we've had conversations around annuities where they do and don't make sense, but I
Yeah, and
heard that and I kind of was my heart just kind of like sunk
yeah,
a little
that's
bit.
hard. And it was probably life insurance if they were using that tax-free verbiage, like permanent life insurance.
Yeah.
So, okay, yeah, I don't know what to say about that other than that's not great, and there should be a method to this madness of like, here are the steps, here's how you get through it,
Mhm.
and you can see that in each of the scenarios that you've given, it wasn't like whole thing goes here
Yeah.
or whole raise needs to now go here. It's more of a process of get yourself out of danger, start to calculate your future goals, start to solve for that. Um, I want to throw out maybe two or three quick things, and you go wherever you want from this. But there are reasons why you throw all of this out the window, and I feel like you somewhat experienced it with a career change
Yeah.
where you may have had some money and it was like, I could follow all the conventional wisdom of opening my Roth IRA and doing this and saving the money here and here. Or I could spend a bunch of money on podcasting equipment and cameras and all the things that are difficult to start and run a YouTube channel like you do. And that has been a much better decision for you. And so this is a risk and return analysis, right? Like some people are not willing to go out, quit their jobs and start something brand new and bet all that money and time on it. And
Yeah.
so the richest people, the most wealthy people I know, most of the time had a moment where they acted completely irresponsible with regard to the order of operations.
Yeah.
Do you know what I mean?
Yeah.
Where they're like, no, this is going to work. And I'm in a tight spot. I get it, but I'm going to sacrifice and I'm going to put money towards this and make it work.
Yeah.
So that's one thing to make sure you remember.
On that, just so I don't forget, that's where I appreciate having you in my life and Capita in my life, because I think a lot of that knee-jerk reaction to your point is, oh, you've got $100,000, throw it in an annuity, throw it into our managed funds here, throw it in so that we can make money off of that. That was never the message from you all. It was,
No.
okay, you're going to go take a risk on yourself. Great. Here are kind of the guardrails that you should keep in mind, your emergency funds. Here's what you should
Yeah.
think about. Let's go do it. Like that sounds
Right.
exciting, but that
And that's
meant
hard
less
for some
that meant
advisors.
less money to an advisor.
Right.
It was just the right thing to do.
Right. Yeah. And then the next thought is really that there are 2 or 3 things after this that you should really start to focus on. Like you're to the point, if you have this much money in a bank account, that you probably should dedicate some to getting your estate plan in order.
Yeah.
Like you really need to decide who's in charge if you're disabled. I mean, we talked about getting life insurance for that and disability insurance, but we didn't talk about who's making your decisions and who's the executor, who gets what personal item, who,
Yeah.
there's a lot of work to do there in estate planning. And it doesn't, compared to $100,000 inheritance, it'd be a shame to take all of that and invest it in things you can't like sell or something like that, and then die without a plan that you could have gotten for a couple $1,000s.
Yeah.
At
Yeah.
most. So anyway, the estate plan's a big one. And then usually right on the heels of that, this next big task would be looking broader at your debt and saying like, okay, you have a mortgage. Is that interest rate so low that it just doesn't make sense to pay off and you're going to make more money elsewhere? Or is it high enough that we should actually maybe forego investing a bit to pay down your debt? And then does the interest rate not matter to you because it's such an emotional burden that it doesn't matter and it changes the way you behave? Then maybe we pay it down anyway. Anyway, that's after. So we kind of worked through dangerous situations, getting free money, calculating your retirement projections, timeframes, optimizing that, getting your estate plan in order, and then working on your debt and risk tolerance around debt and interest rates around debt.
Yeah. Well, and it seems like with this situation and the amount of money we're talking about, we're getting through a lot of these steps in a relatively short amount of time. Whereas the first one was you're going to allocate for the next year, you're going to build up that emergency fund. So it's going to
Yeah,
take
and then
you
it was
about a
like,
year.
we're done talking. I don't want to overwhelm you.
Yeah.
Like, let's just stop there.
Yeah.
Yeah.
But that one just takes more time to get through some of these goals based off of all of the changes in the scenarios. Are we ready to move on to the last one that
I think so. I can't see it really well. Are there other questions
the
or things that
dreaded
need to be?
1099-R form? Is it Tony? And then the entrepreneurial spirits. We appreciate you, Tony.
Yeah, I'll try to be quicker this one.
Okay, this one I think is where, again, hypothetically, let's say that Eric now is still 50, we'll say 50 years old, and he is an entrepreneur, and he has built a business around retirement that he would like to sell. And
Oh, he's built a business that he would like to sell to fund his retirement? Is that what we're talking about?
his business is like a YouTube channel that talks about retirement.
I see. Okay, I'm following you.
Hypothetically. So he's built it up, and then at that point, he sells it for $30 million. So now we've got a very large chunk of money. We've had a little raise. Well, it could be a large raise. We've had a decent size inheritance or bonus. And now we've got an absurd amount of money coming in from a sale of a business.
Yeah.
Because I think you, in previous podcasts, you've talked about how a lot of the ultra wealthy that you know have built a business and built up equity in something, and then there's an exit.
Exactly. It's really interesting. I have a friend who, in his neighborhood, the doctors are the poor people, and everyone else own businesses.
Yeah,
and thought that was fascinating. Not to try to disparage like any profession, But we just always feel like the doctors are the really wealthy people. But it was like in this particular space, the doctors were wealthy. It's just that everybody else in the neighborhood owned businesses, and they were higher. I really, really hope that Eric is talking to us before he goes and signs those documents to sell his business.
Why?
Because there are, and ideally years before that happens. And this is where I reach the limit of my comfort level and technical knowledge around certain aspects, and it's time to bring in a business a selling attorney, like a mergers and acquisition and transactions attorney that can help really structure it well. But I know enough to spot the time to then bring in the expert, and it's go time. So depending on your tax structure, you could be an LLC taxed as a partnership, which is the default, meaning all the income just passes through to you. You could be an LLC taxed as an S corp, which means you're establishing a certain salary, and that's what you pay FICA taxes on, and then the rest comes through and you pay normal income tax on it, but not the FICA tax. You could be a C corp, which has its own tax filing process and its own tax rate, and only pay taxes when you do dividends and distributions out to the owners. You could be a straight partnership, which is probably not ideal, but that could be the case, and then it's taxed just like it was directly to you. Now, that's how the income is taxed, but the disposition of a sale of a business is going to vary based on each of those tax structures. Then on top of that, when you actually get into the asset sale, and most of the ones I've been involved in have been S corp, LLCs taxed as S corps, or LLCs just standard. Then you're talking about an asset sale, or you're talking about a stock sale. And that's confusing when you hear stock sale, because stock sale means the stock of the company. Now, you might not think you have stock, but technically you do, right? So the company, if you sell the whole thing as a business, as a stock, and that means the equipment and the branding and like the goodwill and the reputation and the subscriber base and like all the things together, that's a stock sale. If you sell just pieces of it, then that's an asset sale. Like you could sell just the equipment. Now, the buyer and the seller are going to have differences of opinions on what they want to do. Even if they're buying all the assets, it may be advantageous for the buyer to buy the assets instead of the stock, because they can depreciate the assets in a different way than if they bought the stock outright.
And like with microphones, obviously that's different. But if it's trucks or if it's buildings,
real
or if it's,
estate, and exactly. Big things that have scheduled depreciation over time, which is just the idea that you bought a truck and someday you're going to take it to the landfill. And rather than waiting till you take it to the landfill or the junkyard or whatever to say, oh, I lost my 40, well, not 40, let's go up. I lost my $80,000 I spent on that truck on that day. The IRS says, well, we know it's going there eventually. Let's let you take a little loss each year. That is depreciation. Sometimes people get really confused about that. And they get confused because real estate gets depreciated as well. Because technically, someday we would expect a lot of our structures to be completely demolished and built on new, right? So land doesn't depreciate because it doesn't go down in value, but the structure does. The ironic or different thing is that even though the structure depreciates, over the course of decades, people take depreciation on investment properties and then they sell it for a gain. And so they didn't actually ever bulldoze it and build on it again. And so they didn't get to claim their loss. Well, they got to claim losses along the way. And so when you hear the word recapture, you're recapturing that loss that you deducted when you sell. And then from here, it's capital gains. So that's how like a rental property would work. But in a business transaction, it's important for you as a seller to know whether or not, and in your business, it's probably not as applicable, but an asset sale versus a stock sale, that's important.
Yeah.
I'm gonna shut this because it keeps turning on and off. So then that's step one. Now, we also want to think about, like, are you charitably inclined at all?
Very charitably inclined.
Okay. So let's say that for some crazy reason,
Hypothetically.
you were giving away 10% of this business to some other charitable entity. If you were doing such a thing, good for you. You would be giving away $3 million, right? So you could sell it, take the cash, give it to that charity, and then now you get to reduce your income by the 3. So now you have $27 million of income on which you have to pay taxes. This particular This particular type of income is going to be long-term capital gains.
Okay.
And most likely, I mean, this is all there's a lot of like caveats here, right?
Yeah.
Long-term capital gains. So you are going to pay 23.8% because you've surpassed from the 15% capital gain to the 20% capital gain. And you've surpassed the level at which net investment income tax kicks in for the Affordable Care Act, which is 3.8% Medicare tax on top of that. So that's 23.8 federal, 5% state. You're going to pay 28.8% of everything that is a gain away in taxes. If you give afterwards, if you give 3 away to a charitable location, you're going to save $280,000 times 3. You're going to save almost $900,000.
Doing it in a different way, or if I just took cash out immediately?
If you sell it, we're going to get to the better way. But
Okay.
if we do it the bad way, like the simple way, you sell the business, cash hits your bank account, you transfer $3 million of cash to this charity. You only have to pay taxes on 27 instead of 30. So the $3 million is not taxed. That's the savings on that.
Mhm.
Per million is $280,000. So that's where I'm getting to
Gotcha.
our just 800 and something thousand dollars of taxes saved. That's nice.
That's great.
We could double it.
Ooh,
So
tell me more.
yeah, tell me more. That's such a sales move. What we could double it if you didn't have to pay the capital gains tax on that in the first place, and you got to give it away as a deduction. And the way you do that is before you actually sell, you give the charity the 10% of the business, not of cash. You say, hey, I have 100 stocks. Here, charity, you get 10 of them. I'm going to keep 90. We're going to go into this transaction together. And when they sell, those 10 are nothing to do with me anymore. I'm not paying capital gains tax on that. And the charity says, well, we don't even pay capital gains tax. Great.
Yeah.
So they don't have to pay the capital gains tax. You get a deduction for the value of the business that you gave. Now, the value is going to be fairly close to what it turns out to be, because it's usually not, and you have to be careful. If you do these things too close together, it is an assignment of income, and the IRS will say, nope, we don't like that. You just tried to get rid of taxes. But if you do it the right way with the right valuation experts and everything, then you get to take a deduction for the value of the business that you gave away, and then they pay the capital gains, but they don't because they're a charity. And then you pay just on your portion. The problem with all of this is, what charity is going to be super comfortable being a business partner with Eric in Retirement Nerds on a YouTube channel that you say a lot of controversial stuff? So who knows if they're going to be, if they're going to write so much. See, who knows if they're going to be really that comfortable getting into this type of a business. So usually what we do in that case is we insert, and it's not in that case, it's every case. It's easier to work with a donor advised fund than it is to work with the end charity. Donor advised fund is just an account and an entity that can step in and receive appreciated assets or investments, and you get a tax deduction for what goes in there, and then you can invest it inside this account. It's not yours anymore, but you are kind of the director or the holder of those assets, even though they're not yours. They belong to this charity. But you can grant money from that donor advised fund to whatever charity you want, whenever you want in the future. And even if you wanted to flush it all the way through, that will probably make it easier to give that $3 million to a DAF and then to the charity, because the DAF has been through these types of transactions over and over again. And so they're going to be more comfortable than a religious organization, a hospital, or a school would be at taking on a partnership with you in a YouTube channel.
Gotcha. Okay. So that helps reduce taxable income and helps me get funds, because I'm charitably inclined, into the hands of these charities in a pretty smooth, seamless way.
Yeah, and hopefully we saved close to $1.6 million in that process in doing that.
What else do I need to be aware of if hypothetically we sold the business for that amount?
All of your relationships are about to change.
Explain.
Your relationship with your spouse is about to change, because if you like your work and your excuse to go to work is you have to work and you no longer have to work, you better be really clear about why you go to work, so that your spouse and you are having a real clear, open conversation about this. And this is real. This happens with people who inherit who sell a business for a lot of money. And there's this weird dynamic where oftentimes in the beginning, if one of them has been the main breadwinner and the other one's been stay at home, one of two things happens. Either the stay-at-home parent or person is thinking, great, we get to hang out together. And the other person's like, I thrive on achievement. Like, this is really hard. I do want to hang out with you. I thrive over here and I need that in my day. That might happen. The other one might happen where the person does want the worker wants to hang out more. And the person at home is like, you are messing with my system. Get out and go find, and this happens with retirees too. Go find something else to do. We actually have an employee at Capita who's incredibly bright, and his wife just kicked him out of the house. Like, basically, not really. They're really funny together, but his mind is moving too fast to not be working on something, you know? So anyway, the bottom line is your relationships are about to change. That's just the spouse one. Now you got to think about, like, how are you going to communicate this if you're going to communicate this with your children? And it's different to say no to your children when you can't versus when you won't. That is so different. And I've experienced this a little bit, and I think we all do as we grow in our careers. And it's like, oh, shoot, I could say yes. I don't know if I should here.
Yeah.
And then, especially if your kids know you can, and the answer is no, then it's a different scenario. So you have to really think hard about values, and it becomes way more about passing on values and who you are, and way less about passing on money. The money is actually, maybe it's not the cause of your problem. It is the doorway that introduces some of these conversations. But the reality is, anyone at any asset level should be having these conversations. They just don't have as much of an impetus to create the space to have them because they're just trying to survive. But you're going to spend so much time on money discussions that you did not anticipate having.
Well, and that's just with the family. I think, like, I would get a whole lot more friends if they knew that something like that had happened.
Yeah, that's what your relationship's going to change. Are your friends going to still hang out with you? Are they going to want to hang out with you? There's actually a difference too of, like, convenience when it's not a big deal for you to pay for, I don't know, an Uber for $100 because you need to get from one side of town, like, way across, and the best way to do it is that way. And other people are like, no, we'll do public transit. And you're just like, I don't want to wait for that. Like that, your behavior begins to change when the resource is there. And that can change can your friends still vacation with you? Are you going to, or you have to bankroll them if they are going to hang out with you? And then does that create a weird dynamic? And anyway, so all of these things are, in my opinion, the biggest task ahead of you. Most people think the money is, and I don't. I think it's the relationships.
Yeah.
Now, there are money issues at a certain level, at this level, especially are you still single or are you married?
Married in this case.
Okay. Married in this case, you are, well, after taxes, you're not going to be over the estate tax exemptions, but the current estate tax exemptions, I mean, you and your wife could give away about $26 million, $27 million and not pay any estate taxes when you pass away. Okay. But that's if you passed away today. And the estate tax limits are not climbing as fast as your portfolio should grow. So your 30 should turn into 100 faster than the 26, 27 million that you can give away goes to 100 million that you can give away. Yeah. So you have an estate tax issue coming.
Okay.
So there are ways to solve that easy too, especially since you're so charitably inclined. You could say, like, I'm just going to give to my kids whatever I can give based on the estate tax exemptions, and then everything else goes to charities. Or it drops into that donor advised fund, and then the kids have to work together on creating foundations and things and serve people. I mean, there are a lot of different ways to structure all of that. But the point is, your biggest task is right before the transaction. You have to be really careful to get the best deal you can get, the best pricing, save as much in taxes, and make sure that that money actually lands in your bank account. And then as soon as it does, then the task changes entirely to relationships, values, people. Like, how are you going to structure the rest of your life that way? And then after that, because we want to think about those things before we talk about estate taxes, because some estate tax moves require you to put the money in other people's names. And so if you are thinking, like, I don't want my kids to have this much influence, insight, or exposure to this kind of money. Well, that takes away a couple estate tax moves that some planners might recommend.
Hmm.
So you really want to think values and people. And it's okay, in my opinion, to pause for just a moment. I think some people get really nervous when they have that much cash hit. I think it's okay to pause for a minute, like take some time and really figure out who you are. And I don't know if it was Mark Cuban that said, like, money accentuates who you are. If you're a terrible person, it'll just make you worse. It'll make you insufferable. And if you're a great person, it'll make you better. I don't think money makes people bad. I just think it makes you more of what you are. But with this kind of money forces you into conversations that we all should have anyway.
Hmm.
We just don't have the time for them.
Yeah. Well, and it's interesting, the breakdown of this one. So much of the past ones were getting you away from the road, getting you out of trouble. And if you're selling a business for $30 million, your income has probably been pretty good. That's not to say that I wasn't blowing it all on
You
crazy
don't even
stuff in
need
the
income
meantime.
anymore, do you?
Right.
Yeah.
Right. And so it's if you go through this order of operations from a financial perspective, you can just knock it all. The money conversation is kind of like taken care of in a way, or should be, and then it's more of the relationship aspect. But we were talking about this before. You have lottery winners who win hundreds of millions of dollars and they have financial problems, but I think that's more to your point, if it accentuates
Who they
who you
were.
are and your money habits before, versus it being a money problem.
Right. And they're not fully thinking about the money values they want to exhibit
Yeah.
and to share.
Yeah.
It's so funny too. Thing that cracks me up, Eric, is you'll get somebody like this and they shouldn't, like, Social Security is such a minor aspect of this person's financial picture. And we will get people who are in this boat who are just obsessed over maximizing Social Security. It's like, you could fail. You could not take Social Security and be
Yeah.
fine. And don't get me wrong, I get it. You want to get as much as you can of what's yours and what you've paid in. But it is funny sometimes where the focus goes for certain people.
Yeah. That's interesting.
I don't know. That was a pretty different one. That much money takes you out of all of these process checklists and you're pretty much good. And now we're like, who are you?
Yeah, it's still important to establish those, right? It's still important to just say, "Okay, I do need to think about if I'm retiring at 50 in this case, in terms of I sold my business, I've still got another potentially 50 years to live." So structuring it in a way there, but so much of that can be handled with smart decisions, setting something up, automation. I think you're a big proponent of automation.
Absolutely.
And then those relationships, because one of the biggest retiree regrets, and you mentioned this on the biggest ways to destroy your retirement, is not being able to say no to kids
Right.
when you should, right?
Or
And
when you could.
and
Yeah.
creating improper behaviors from children,
Yeah.
or
It's true.
dependencies.
We've
Should
gone
we
a
get to
long time.
some questions
Yeah.
and then wrap this up? Let's see. Here's one. As you brought up disability insurance in case you can't work, what about long-term care insurance if you are alive and can't work, but you need skilled care that could eat at your estate and savings?
So long-term care insurance is tricky because a lot of the people that need it can't afford it. And a lot of the people who can afford it don't necessarily need it as much. And this is where a lot of people will differ. But just to differentiate, long-term care insurance, this is the idea of as you get older, you can't take care of yourself anymore. This is usually after retirement. It's like the next phase of life after retirement. And most people, I think the last stat I saw was 22 months, something like that, is the average long-term care stay if somebody needs like full care facilities.
Well, and it's interesting because it's either a very long time or a very short amount of
Yeah,
time.
or like weeks.
Yeah.
Exactly.
Yeah.
So that's really hard. If we struggle with this in the sense that if it's such an emotional thing. I mean, we have clients die every year
Mhm.
and we watch their accounts as they go through that process before they pass away, right? I just haven't seen that many people blow through portfolios for long-term care.
Hmm.
So it's been a hard one for us to say, like, we got to get behind buying a bunch of long-term care insurance because the risk, we have 2,600 households. Now, not all of them have passed away, right? So we don't have a good sample size, bottom line. And the stats will show you that the risk is there. My preference is to be self-insured here.
Okay.
I'd rather just try to save so much money that even if I needed long-term care, it's going to be fine. We could just pay it out of the portfolio or the income.
Mhm.
And think about this too. If you are single and you go into long-term care, you probably are going to sell the house. And there's a big asset there that can cover a lot of the long-term care expenses. You're also going to simplify your life in a big way. So your actual expenses can go down. And that's, I'm talking about our state. Every state's a little bit different. The tricky one is when one person is really healthy and one person needs complete like memory care, and that goes on for a decade. You're running two financial households at once.
Yeah.
That's the hard one. Um, so I don't have a great answer for you in terms of like what should you do, because this is everybody's different. Some people feel really good about getting some insurance in place because they kind of can check that box and know they're covered. And if you have a family history of it, and like Alzheimer's, and or a family history of like people living a long time but without the mental awareness and without being lucid, like that is a scenario where I would consider potentially looking at some insurance, but I don't end up doing it a lot with
Okay.
people. But disability insurance is different. So it's like there's the retirement date. Disability insurance is typically for before that. And then there's your retirement years, and long-term care is for after that. But normally you don't have either in that window, or you don't utilize either in that window of retirement. You utilize long-term care after and disability before.
Awesome. You've been incredibly generous with your time. So we're going to let you
Yeah, I don't think I told my wife where I
wrap this
was.
up. But for those watching, thank you for tuning in. And then we'll post this so that everybody.
Is there there haven't been any other questions or things to chat
We've got
about?
some very nice comments from everybody that's going on here. If you have ample assets and accounts that are experiencing financial freedom, is life insurance necessary?
Wait, say that again.
If you have ample assets and accounts and are experiencing financial freedom, is life insurance necessary?
Probably not. Probably not. You're probably self-insured. I mean, there are a few certain circumstances when it may make sense, and you might want to solve for something in particular, but the answer is you kind of solved it yourself. Good work.
Yeah.
Well done.
Okay, I'm going to go ahead and let us wrap this up. There's a disclosure that I think.
Oh yeah, and we probably should have talked about this throughout, but bottom line is like we've talked about a lot of very specific things about hypothetical situations. Like these are not real people, and this was a process. You should be thinking about this as education and the process to work through, and not as, oh, you should be doing this and this and this. Everyone should be doing this and this. Yeah, this is probably the most prescriptive we've been on any of our sessions. So I hope people understand that was prescriptive for a fake person.
Yes.
And not necessarily for you.
All of them are fake.
All of them were fake. Anyway, yeah, thank you for letting me get that out there. I usually don't love to throw out a ton of disclosures, but it's important people understand and think about these things carefully and talk to professionals when you feel like you need to.
Okay. Thanks, Zach.
Thanks, Eric.
Appreciate you.